Alrighty, welcome to another episode of Modern Money. How you doing, TJ?
Doing well. Just got back from vacation. Excited to get back to producing some content.
Absolutely. I think maybe you look a little tanner today. It's great.
Yeah. Got a little sun, so feeling good. Had to get out of Boston and get some warm weather.
Absolutely. And I like that you threw it in. You want to produce some content today and you're wearing your content shirt. So perfect.
Exactly, on brand for sure.
So I think today we'll be doing a little discussion around IPOs. How does that sound?
Sounds good. Right in our wheelhouse. So I think we'll have some good topics to cover.
Absolutely. So it could get a little long, right? If we're starting from day one as an employee. So maybe it makes sense to start as we're as you're approaching potential IPO, right, with your
Sure.
company. There's whispers and whatnot. As far as what you've seen and clients you've worked with, what do you think about, again, they believe an IPO is coming maybe in the next, 3, 6, 9 months. What do you see with your clients as far as planning for that, or
Yeah.
exercising options and whatnot?
Yeah, I mean, it's one of those things that some people tend to not do a lot of thinking ahead of time because they think that, let's wait until that IPO event does occur. But there's a lot of pre-planning that you can do to really make sure that you're comfortable when that potential kind of liquidation event comes and you have a potential windfall. I mean, this is the most common way I see, especially for younger folks, where they're coming into some money, is that pop from going from a private company to a public company. And sometimes they are caught off guard by the tax consequences. They're not sure, what to actually do with the money, as far as like transitioning from just owning their company's stock to kind of more of that diversified portfolio. So I guess the biggest thing that I, start with is just really understanding what kind of equity they own, whether it's stock options or RSUs. Typically, in that pre-IPO event, they're going to have stock options instead of stock options, which have that special tax treatment. And so one of the things that we want to look at is, kind of what is their strike price? So what is the price that they can actually pay to purchase shares ahead of time compared to that, fair market valuation? And so when they are a private company, they're going off of that 409A valuation, which is, every private company has to be evaluated every year so that, the employees are aware of kind of what that consequence is if they are to exercise early, because there can be kind of alternative minimum tax consequences to doing so. And so really the first thing is just actually understanding their personal finance situation, because before you can even start thinking about tax planning, you want to understand, somebody's cash flow, somebody's ability to even exercise these options, because you can get into scenarios where you may not even have the cash on hand to, depending on what your strike price is, to exercise those options. Now, typically what I see is that because the strike price is so low, that's not normally a problem, but it definitely can be. But then the other thing is determining, if they're going to exercise ahead of time, is there the capability for AMT? And then really understanding why would you even want to exercise ahead of time? And it's really understanding the tax treatment around long-term capital gains and things like that. So I guess that's kind of where I start. You can cover, I'd like to hear what your starting point is.
For sure. And I think you bring up a good point as far as their individual situation and the cash they have, right? Because sometimes, we might get excited about an IPO coming up, or someone might reach out to us and, what should I do? What should I do? And it always comes back to like their situation, their goals, right? And as you mentioned or alluded to, they might have X amount of cash, a fixed amount of cash, right? And that cash may be limited, or it might be spoken for, right, for a down payment or something. And
Right.
so even though the IPO is exciting, the cost to exercise, not just purchase the shares, but like you mentioned with the AMT, potential tax implications too. Not everybody can afford to exercise shares, right? Even though on paper, in certain scenarios, it might be advantageous to exercise, but sometimes it's limited. Sometimes we don't even have that choice, right?
Yeah.
And I guess another consideration I see is sometimes folks, pre-IPO or approaching an IPO, or almost kicking themselves, or it's too late, right? I should have done something. I didn't. And there's some truth to that for sure, but I think a lot of times there's still something, at least with ISOs, you
Mm-hmm.
could do, right? Because even if say your IPO is 3 months out, you may, that may be true, or maybe delayed a little bit. So your IPO, we'll call it 3, 4, 5, 6 months out. It's uncertain, right? We don't know. And then a lot of times employees are locked up for another 6 months, right? I guess where I'm going with this is exercising ISOs. The point of doing it generally is to be able to exercise and hold for 12 months, right?
Mm-hmm.
And so if you're, say, 3 months before an IPO and then maybe 6 months locked up, like even if you exercise, quote, late,
Right.
you still kind of have 9 months, no problem, right? And then you would have to weigh, 9 months later, you're now potentially could be liquid. Do you sell at that point? And do you like that price?
Right.
Or do you hold on for those 3 more months and hope that price kind of stays steady? So I guess, generally to sum it up, take someone's individual situation and their cash balance, as a key factor, but also realize, hey, it's not always too late to do something.
I think, like you said, like in an ideal situation, you want to exercise ideally as early as possible if you do anticipate that IPO event, right? Because that most likely you're going to see a large increase in the share price. And so if you can exercise your options when the 409A valuation is very low, then you're going to have a small spread, which is going to limit your AMT exposure. And then it also gets the clock ticking for that 12-month period, right? 2 years from the grant date, 12 months from the exercise date, so that once you do go public, your first open trading window, you can sell, as much as you want or as much as you've exercised. If you want to take, diversify and reduce your concentration risk. And now that whole amount is taxed at that lower long-term capital gain rate. Plus, you never really paid AMT if you did it when the valuation was low enough. And so, yeah, the longer you wait, the more you open up yourself to both AMT, plus, like you said, being a situation where, you've exercised, but you haven't met that 12-month holding period. So now you're like, well, do I want to diversify or do I want to continue to hold to try to get the lower rate? And that's when you can get into some kind of dangerous scenarios where I like to always prioritize the financial planning and the concentration risk over the tax planning. The tax planning is great. We love to save taxes where we can, but we don't want to just try to maximize the tax savings when there's the potential for declines. Now, that's obviously short-term. When you're looking at short-term price movements, it's totally up in the air about what could happen. But that's really where we want to determine like how much is enough for you, making sure that you are carving out, a portion of that to put towards your diversified assets so that you solidify, your path to, financial independence or whatever, like you said, your individual goals are. I think that should take priority. But yeah, in an ideal world, you're exercising as early as possible, limiting the exposure to AMT and getting the clock ticking for the long-term cap gains.
Yep, totally agree. And you bring up some good points, right? And ideally, right, in a scenario where there is an IPO, in hindsight, right, you want to exercise as early as possible. But, we're sympathetic where usually when that 409A or that valuation is lower, right, earlier in the company trajectory, generally there's a reason, right? There's a reason why it's lower. So it's easy to for us to always say, oh, it would have been nice to exercise, but
right.
It's like, hey, when you're just maybe starting, the company's newer, they've only raised a couple rounds, they're maybe burning cash, right? Like a lot of folks are burning cash, future fundraising is uncertain. It's
risk.
messy, right? Maybe not all of it's vested. So there's a reason why people don't. And so it's hard. I guess, another thing is like psychologically, it's kind of tricky where say you're on the other end where it's like, you're bullish from day one, you're exercising from day one, you're fully exercised. So basically during all of this uncertain time, you are certain, right? You are committed, you're all in, you're exercising. And then finally you reach that, metaphorical finish line, IPO, lockup's over, you're potentially, have liquidity. And now, from what I've seen, it's hard to kind of shift. It's hard to say, okay, now I'm going to take money off the table. Now I'm going to sell half my shares, because from day one, when things were not rosy, you were fully committed, and now you may think the rocket ship's going to continue going up, and you may be right, but it's hard to say, okay, I'm going to jump off this metaphorical rocket ship. So it's certainly tricky, and as right, it's like a blend of like investments, tax, financial planning, but also like a lot of psychological stuff, a lot of conversations around FOMO and
Mhm.
regret, and if this then that kind of scenario playing. So it's fun to be a
The
part of.
the way I look at it and phrase with clients is like, I've seen specifically with like Zoom and most of these kind of pandemic type company stocks is during the moment, it felt like, oh, it's going to keep going up and up forever. And even now I was like, oh, I felt like I even felt that FOMO, even though it's not my money. But I kept reminding the client, it's like you have this windfall right here. It's worth a lot of money. And it's not like you're going from just owning your company stock to cash, you're transitioning to a diversified portfolio. So yes, there's opportunity costs between the two, but it's not like you're going to still hopefully earn returns that are going to provide a path to financial independence, right, over the long term that are sustainable. So it's you're still going to get returns there, just the delta of what you could have. But again, you've already benefited so much. It's just one of those things where there's probably going to be a reversion at some point. And as we've seen with companies like Zoom, I mean, there's been an 80% plus drawdown since the highs during the pandemic. And so that was a very unique situation. But in the future, I'm sure there'll be more, bull markets in the future where these tech companies have these crazy valuations. And it's like, yes, they can keep going on and on for a long time. But eventually there's usually some kind of reversion. That doesn't mean it can't be a great company long term. But it's all about like, what do you actually want to, do you want to be able to use your money? Do you want to be able to use your windfall? When is enough? And, at some point you really want to kind of quote unquote cash in your chips and transition to that diversified allocation. So that's kind of the case study reminder that I remind myself about. And now, moving forward, I have even more conviction kind of after seeing what happened during the pandemic, with these tech companies.
Yep. Again, bring up a good point. And it's always challenging, right, for us as advisors, where we're almost there is some negativity to what we do, as far as looking out for the rain clouds, looking out for the storm clouds,
Right.
thinking about these more negative scenarios. But it is very challenging, right? Even in our seat, as we spoke about 2 weeks ago, our last episode, we talked about all these financial books we've read and psychology of money, right? And we're studying this stuff, but it's still hard. Like in the middle of an IPO, the stock's jumping up, and it's hard. It's exciting, and it's hard to kind of rain on the parade and say, "Hey, we were planning on A, B, and C." And again, it goes two ways, right? Sometimes the rocket continues to go up, and then other times, it's a hard crash.
For sure.
And you've already won so much, like on a scale of 1 to 10, maybe you're already at like an 8. So it's like, are we shooting for that 10, or are we going to try to watch out for the 2, because we really don't want to go down to a 2. So it's hard. And again, it always comes back to, as you pointed out on a few episodes, comes back to the client, comes back to the planning. And from our end, we try to tell clients, we know we're not going to time it perfectly. That's a fact, right? So we in theory, that should not be the goal, right? I'll tell you right now, whenever you sell one share of a company, we can guarantee, we don't guarantee much, we can guarantee that is not going to be the highest price that the company will ever be at, right?
Right.
Even if it's by a penny, right? You're never going to be perfect. So you might as well, focus on yourself, take care of what you need, and then
live with the consequences. Yeah.
Yeah.
That's the thing. Once you make a decision, you kind of got to just say, I'm comfortable with the fear of missing out, right? If I'm to diversify, I'm comfortable with that. I'm not looking back. I made this decision at this point in time based on the information I had. And you kind of go from there. Just one thing I wanted to bring up as like another case study is like, let's say you were an Amazon employee with stock options in the late 90s. You would have experienced multiple 90% drawdowns. Now, Amazon's had obviously an amazing return over the last 20 years, right? But the chances of you withstanding 90% drawdowns, staying invested, just psychologically just is highly, highly unlikely. And then also, there's situations where like, what if you had, even though Amazon's been such a great performer, if you had exercised your options and paid AMT, and then all of a sudden the share price declines. There's a lot of situations in that 2001, I'm sure it happened most recently, I haven't heard any stories about it, where people exercise shares, pay or owe all this AMT, but then the share price has this 80% drawdown, and now you're left with this tax bill But you don't have the money necessarily. So there's some nightmare scenarios that can happen. So you really want to be careful with just kind of understanding the range of outcomes there, and like always think about what's the worst case scenario, what's the best case scenario, what's the range of outcomes, and what am I comfortable with from minimizing my regret. So that's kind of how I think about it. But I think I lost your sound for a second.
Yeah, you mentioned, yeah, you couldn't think of any recent examples, but yeah, I know of a situation in the last 12 months where that exact scenario happened, where post IPO things were looking good, aggressive exercising, large AMT bills, price comes crashing down, and that's again, it's AMT short term. AMT will come back to you. The price could always recover, right? So it may not be the end of the world, but some people can swallow that. Some people, they have more trouble with, and it's certainly challenging. So post IPO, right? Post IPO, why don't we chat about a little bit of RSUs? I know we chatted about that a bit offline. So you have all these options, right? You've exercised, but as you're approaching IPO and after an IPO, for sure, a lot of times the equity changes, right? ISOs earlier on, maybe NSOs mid stage, and then RSUs more later stage.
Yeah.
And there's a little bit of a different dynamic and tax dynamic there. So how do you think about RSUs as they vest, and how clients maybe handle them, and maybe how they could or should?
Yeah, so I mean, obviously the options are more sophisticated from a tax planning perspective. The RSUs are nicer because you're getting shares. You don't have to pay anything for them. So you know that you're going to receive something. Unless the share price drops to zero, you're going to receive some kind of value there. When the shares vest, you're taxed as income based on the fair market value of the shares on that date. So it's just like getting a cash bonus in the form of your company stock. There's no tax benefit to holding. Sometimes people think there's some kind of tax benefit to holding those shares. Once you receive those vesting shares, you need to make a decision. Do you want to increase the exposure in your company stock? Because it's basically like you taking a cash bonus and buying your company stock with it. Or do you want to, again, think about what is your overall, how much do you own of your company relative to your overall investable assets or net worth? How much are you comfortable with? And are you going to sell and take that money and transition to using it either for something or putting it in kind of your diversified portfolio? And so, and like we've talked about, even from a tax perspective, from a withholding perspective, you're probably going to want to sell some shares anyways, because of what happens often is people under withhold for their vesting RSUs, because employers will withhold a flat 22% for vesting shares. But when you look at people's household income, especially for like dual income households, they're usually in a much higher marginal tax bracket. And so what happens is there could be a 15% delta. I've seen that recently with clients where they just were massively under withheld because, again, your employer doesn't know anything about your personal tax situation. So they don't know your outside income sources, like investment accounts, dividends, things like that. So again, you can get caught off guard come tax time, owing, a large amount of taxes. And then you don't want to get in a situation where, hopefully you do have that cash reserve, but if you didn't, because you didn't have that like foresight for financial planning in general, then you can be in a situation where it's like, well, now I have to sell from my investment account. Markets could be down. You don't want to ever be in that situation. So really important to understand, your withholding, and then do you want to purchase more shares in your company stock, basically.
Yep, I couldn't agree more. And we're not professors, but I really think if you're teaching sort of a behavioral finance class, I think RSUs could be at least a full one-day class or several, because it really is interesting. And sometimes you ask the clients these questions, and we know what the answers are going to be, right? It doesn't mean it's easy to act, right? If you got that famous question is, right, if you got a $10,000 cash bonus today, right, and it just hits your bank account, what are you going to do with it? Is the first thing you're going to do is just rush onto your phone, log into your trading account and buy the company stock? Is that the first thing you're going to do immediately? No, never, right? It might be, I'm going to save some, I'm going to invest some, maybe I have this vacation coming up, right? Maybe I'm going to donate some, right? It's it's a mix, right? It's always a mix. And that rush to buy company stock is never on the top, 5, 10, 20 things.
Yeah.
But commonly with RSUs, that's what happens. And sometimes that's tricky, like you alluded to, and why it is like a cash bonus, right? Why it is like a cash bonus is because of the tax ramifications, right? If you got a cash bonus, there's tax, there's withholding, state, federal, Medicare, Social Security, right? And then you end up with X. So if it was a 10K bonus, you might end up with we'll call it 6K, right? In your bank account. Same thing with RSUs, right? 10K of RSUs are hitting, we'll call it 10 shares. You're not going to end up in your account with 10 shares. You're going to end up with, we'll call it 6 shares, right? Because they're going to liquidate 4 shares for those taxes, federal, state, Social Security, Medicare, right? So that's why it is the same, right? And like you said, if you sold it, if you could time it perfectly, it hits the account, you sell it immediately, there is no tax ramification, right? Again, same thing. If you logged into your account, bought some shares and then sold immediately, right? There would be no tax ramifications. But there is that misconception about holding long term when there are benefits if you do, well, if you hold it and it goes up, it's better to sell after 365 days than before, right? But if you sell it, right away or close-ish, there are essentially no tax ramifications. But the big, that's just the psychological thing, right? But so we're almost being defaulted into something that could have ramifications. One of those things is what you mentioned, right? The under withholding. Your tax bracket maybe is 35%. You're being withheld at 22%, right? And just again, easy math. So that's a 13% delta. So on 100K of RSUs, which is definitely not uncommon,
right?
That's 13,000, right? 13,000 shortfall. Double, triple, quadruple, 10x that, right? Which we've seen, and that certainly can be a significant pain. And then again, like you alluded to, we've certainly seen a lot lately. You're basically that bonus is hitting at a high price, right? So you're getting, we'll just again using cash as an example, you're getting that 100K bonus, right? So it's really getting hammered tax wise, and then because you have that shortfall come tax time, I need to sell some of these shares. They might not be at 100K, right? They might be at 50K. Or you mentioned Zoom, right? I don't have the chart in front of me, but you mentioned 80% drop, right? So if you have RSUs vesting at X price, and that means you're going to owe a big tax bill. You're going to have that big delta, and then now I have a shortfall. I need to sell a lot of these shares to make up for that tax shortfall, and the value is 80% dropped. I mean, I think it's, you have to sell basically 5x the number of shares,
right?
So it's certainly
bad situation.
It's a bad situation. Obviously, like you mentioned, holding RSUs, that they are can be beneficial, but right, again, broken record, it comes back to the client, comes back to the planning. How much of I don't know if I froze there. You mentioned
a little bit.
You mentioned Zoom, you mentioned Amazon, right? How much of that do we want to hold, right? Is it 2%, 5%, 10%, 20%? And let's kind of stick with that framework. At the very least, right? Generally, it makes sense to at least sell a little bit of the RSUs just for that tax component. Be like, okay, so we're good tax wise. I don't know if
I actually saw a situation recently with just like a prospective client where they were a 1099 contractor for a company that they were receiving equity compensation. So there was no taxes being withheld. They were receiving RSUs. And like you said, it was a high point when they received the RSUs. They never sold any. And then the shares dropped, I think it was at least 60, 70%. And so they're being taxed on that high. Like you said, they had no withholding. And now they have this tax bill and the shares are worth, 70% less. Just an awful situation to be in. So it's really, really important, especially if you tax-wise, you want to make sure, even if you're, a W-2 employee, that you are having shares withheld, because if that share price tanks, like you talked about, then you're in that nightmare scenario. One thing I did want to talk about just in general, back to the planning side of things, is I think a lot of people too, and this just goes for general financial planning, they don't think about their money as being fungible. So you want to factor in your RSUs as income to you because it's being taxed as income. And so how can you use and maximize the value of those shares to the best ability? And so if you're not maxing out your 401k, if you have the ability to do after-tax contributions to your 401k for a potential mega backdoor Roth, right? These are things that cash flow wise, maybe you couldn't afford to do normally. But if you're using your RSU income, you can kind of pay yourself back if you're kind of pushing all of your money from your salary into these things, because you're maximizing the value of all of these different accounts. HSA, 401k, like I said, after tax for mega backdoor Roth, a backdoor Roth IRA, right? Like all these are things that are making your dollar spread further, but people don't always think as their money being fungible. Or if they're a married couple, let's say one of the spouses, has a much lower income, they're not able to normally max their 401k, right? You want to use all of these resources together so that you are stretching your dollars as far as possible. So what are your thoughts about that?
Yeah, I totally agree. I think it's always smart to bring it back to the client. I think, related to that, right, is sometimes we mix up or we get confused with risk tolerance versus, what the necessary risk is that you need to take, right? For example, just because you can, drive 100 miles an hour around a fast curve, right, doesn't mean you need to, right? Again, I'm not into, race car driving, right? But if you're like, maybe a mile ahead of the next person and you're coming up on the finish line, right, and there's a sharp turn, you could, right, go a million miles an hour around the turn, right? But you don't need to, right? You can just kind of slow down, slow your roll, cruise in, right? 40 miles an hour, nice and safe, right? And sometimes we mix those things up, right? Where and a lot of times we'll see we're looking at clients and we want to like bulletproof their situation, right? And they're highly talented, highly employable, high earners, right? They have a lot of their sort of offensive things are going for them, right? The income, the investments. And so when we think about IPOs and RSUs, having everything concentrated in one company, right? They don't need to do that, right? They don't need to place a big bet, right? Somebody who's maybe, desperate on their last dollar,
right,
might maybe need to like bet it all, on a sporting event, right? They might sort of need to in order to pay rent, right?
Exactly,
But some folks with high incomes, high asset levels, right? Just because you maybe aren't comfortable with a large amount of risk doesn't mean you need to take it, right?
Yeah, if you've already won, why are you still playing, right?
Yeah, exactly. And you could always, and I think sometimes in these conversations, I'm certainly guilty too when talking to clients. It's like the conversations around like hold or diversify. It's almost like hold or sell, but you could always do both, right? It's not like A or B. It's like why don't I do A and B, right? Why don't we say if you're at 90%, right? What if we moved it down to 40%? Still a lot. You still own a lot of this company, but you've taken a lot off the table, right? You've kind of done both. So it's sort of win-win. If the stock goes up, you still win. Stock goes down, well, hey, good thing you took some off the table.
And to that point, one thing that I also think people look past a lot is looking at what is unvested on their vesting schedule, right? And factoring that into their concentration risk. Because if you're going to stay with your company through the life of your vesting schedule, you basically have illiquid skin in the game. And that's increasing your exposure to the company. So yeah, you might say, well, what's vested only represents a certain percentage of my investable assets. But it's like that could argue even more to diversify because you actually have access to sell your vested shares and you have all this unvested illiquid skin in the game, which no matter what happens to the share price, like you're going to participate. So make sure you factor that in. If you feel like, oh, I'm perfectly fine, I'm diversified, but it's like if we factor in all the unvested, you're actually much more highly concentrated.
Yeah, I think that's a good point, right? We're maybe hesitant to sell everything, right? Because I don't have any exposure. I'll have that FOMO factor, right? There's the Slack or the water cooler high fives, and the stock goes up, and I don't hold any shares. Well, it's like, well, you do because that unvested stuff, right? It's still being positively influenced. You can't access it today. But if the stock, is 10xing, your shares are getting that much more valuable. And when they are accessible, they're now worth that amount.
Exactly.
So a lot of mind tricks. That's why it's important to us to
Jedi.
right. It's important for us to pay attention to the financial planning and the tax component, but also the psychological stuff too, and have these conversations. And again, it's imperfect, right? And we want the clients to be educated and make the best decision for themselves. And that, that doesn't always mean, or maybe rarely means, that it's the number one most optimal, to the dollar financial move.
Exactly. I focus on regret minimization. So it's like, how can we minimize the potential regret in any scenario that happens? Are you going to be comfortable with the outcome? Are you still going to be able to do all the things that you want to be able to do? Whether it's, I don't know, buying that house, putting your kids through school, traveling, like, are you going to be able to do that in any scenario, based on what we're going to do from a financial planning perspective? I mean, that's really, I think, because again, no matter what happens, if you're able to do those things, then it doesn't really matter. Because at the end of the day, I just think, like, whatever you're able to do with your money, that's what's most important. It's not about kind of maximizing the monetary value in every scenario. So.
Amen. I think that's a good note to end on. I'm not sure if you have anything else to add, but I think that was okay. That was a good conversation as always. We've had a lot of IPOs in the last year. We'll see how things continue going here, but we may have a lot in the next year. So it's good to think about it, good to plan, and good to factor in that regret minimization as you mentioned.
Yeah, absolutely. And I'll just say, if you are in a situation where you are pre-IPO or even post-IPO, like, you really should be sitting down with a tax professional and financial planner. It's worth your time and investment to run these numbers. There's huge planning opportunities from optimizing taxes and just making sure that you avoid some of these major pitfalls that they're really, like you said, they're really easy to fall into. And having that unbiased third-party professional who is required to provide advice in your best interest, it can make all the difference. This is a big potential windfall event for people, and it can really set the trajectory for a very easy path financially moving forward.
Yep, absolutely. I think it's important to sit down and factor in a lot of different possibilities, right? Too often we see, the value at 20, and all of the scenario planning is, what will I do if it's at 30, 40, 50, 60, 70? And it's like, well, what if it's at 10? It's like, oh, I never thought of that, right?
Exactly. Always consider the range of outcomes, for sure.
Absolutely. But no, good chatting, TJ. Always appreciate your perspective. And
likewise.
Until next time.
Take care.